So hello my colleagues, and I hope everyone is having a quiet Sunday morning here and a good weekend, long weekend, right? President's weekend. So I want to pick up on chapter 2. This is part 2 here. So I left off right here. So the important words I want to discuss here is tangible assets, okay? So sometimes companies will buy other companies, right? And they acquire the company's tangible assets, which are like its inventory, physical, right? Tangible, you can touch it. Plant and equipment, property, and that's going to be on its balance sheet, okay? So in many cases, the firm may pay more for the company than just the book value of the assets it acquires, right? And again, it's book value because the assets probably depreciated, right? So the question is, why are they paying more than the book value? So the difference between the price paid and the book value is recorded, and this is an important word, as goodwill. And two words here, and intangible assets. So what is goodwill? That's the difference between the price paid for a company and the book value assigned to its assets. And intangible assets, let's click on that. And again, these you can't touch, they're intangible. Non-physical assets such as intellectual property, brand names, trademarks, and goodwill. Intangible assets appear on the balance sheet as the difference between the price paid for an acquisition and the book value assigned to its tangible assets. All right, so these two items are important, and I sent you that Merrill Lynch document, and I think you should see them on there. So, for example, in this example, Global paid $25 million for a firm whose tangible assets had a book value of $5 million. So the remaining $20 million is goodwill and intangible. Okay, and I believe let's see, they show you that in table 2.1. Okay, so that's important. All right. So if the firm assesses the value of these intangibles declined over time, it will reduce the amount listed on the balance sheet by an amortization or impaired charge. And these again are important words because the value of the intangibles has gone down. All right, so they're allowed to do that. And again, these are not amortization is not a actual cash expense. I want to go back to table 2.1 for a minute. I don't know where it went. Let me go back for a minute here. Oh, here we go. Sorry about that. So here was table 2.1, right? Here's the goodwill. I just wanted to show you this. The goodwill and the intangible assets, right? You see that right there? So just want to make you aware of this, okay? This is important to know. So here's the balance sheet. Remember we went through this in part 1. So I want to shoot now over to... All right, so let's examine now the liabilities. So liabilities are here's the current liabilities. And again, this is short term. All right, short term. You see, within 1 year. So these are considered short-term current liabilities. And they include accounts payable, which is what you owe, the amounts owed to your suppliers for what you purchased, right, on credit, let's say. Any short-term debt or notes. And any salary or taxes that are owed but have not yet been paid and deferred. Okay, so that includes salary. So these three things are included in the current liabilities. So I'll highlight those, right, because that's important. So the difference between current assets and current liabilities is the firm's net working capital. Okay, and net working capital is current assets minus current liabilities. right? So let's click on this. The difference between a firm's current assets and current liabilities that represent the capital available in the short term to run the business. And that's all that is. So in 2018, Global's net working capital totaled $9 million, and that's $57 million minus $48 million. So that's important to know, all right? So long-term liabilities are liabilities that extend beyond 1 year. Okay, these go further than 1 year, and these are long-term debt or bonds. So it's a loan or debt obligation with a maturity of more than 1 year. Okay, so this is more than 1 year. When a firm needs to raise funds to purchase an asset or make an investment, it borrows these funds. All right, capital leases are important, right? This is a lease viewed as an acquisition for accounting purposes. Okay. So typically when you lease something, it's looked at as an acquisition. And it's on the lessee's balance sheet, and the lessee incurs depreciation expenses for the asset. In addition, the present value of the future lease payments is listed as a liability, and the interest portion of the lease payments, if there is interest, right, is deducted as an interest expense. Okay? And that's called a financial lease. So these are long-term lease contracts that obligate the firm to make regular lease payments in exchange for use of an asset. All right, so they allow the firm gains use of an asset by leasing it from the owner. Let's say you lease a car, right? Or lease a building, whatever here. All right, so deferred taxes, right, are taxes that you owe but you haven't paid yet, and that's pretty straightforward. Firms generally keep two sets of statements, one for financial reporting and one for tax purposes. And this is a real important consideration, right? All right. All right. Hold on. Hold on. Let me get that. Occasionally, the rules for the two types of statements differ, right? And again, these will be on the as a liability on the balance sheet. Okay. All right. So the last item on the right side of the balance sheet under liabilities is the stockholders' equity. So the difference between the total assets, right, and liabilities is the stockholders' equity. So this stockholders' equity makes up the last portion of the total liabilities in stockholders' equity, and it's called the book value of equity. So it's an accounting measure. Book value is an accounting measure of the net worth of the firm. Okay. And again, it's from an accounting perspective, but it's used for that. Okay. So I mean, and again, they make a point here that you would like an accurate assessment of the true value of the firm's equity, but this is not the case. Many of the assets listed on the balance sheet are valued, all right, based on their historical cost rather than their true value today. So that's one problem, right? So an office building is listed on the balance sheet according to its historical cost net of depreciation, but the actual value of the office building today may be very different and possibly much more than the amount the firm paid for it years ago. And, real estate goes up, right? So a second and probably more important problem is that many of the firm's valuable assets are not captured on the balance sheet. Okay, so there may be a situation where these are not on the balance sheet, right? So again, you got the intangible, right? The expertise of the firm's employees, and this is important, intangible stuff. The firm's reputation, the relationship with customers, the value of future research and development innovations. And this is why you can't have the true accurate assessment of the firm's equity. So these are all, assets that add to the value of the firm, but don't appear on a balance sheet. All right, so that's one reason why. So it's important to understand the actual market value of the equity, okay, and it's not the book value. So the market value of the equity is basically the number of shares outstanding, and everyone should be aware of this, times the current market price per share. So this is the current market price per share, and they often call this equation is often called the market cap. You'll hear them talk about, oh, here it is right here, the market cap or the market capitalization. And the market value of a stock, again, this does not, all right, depend on the historical cost of the assets. It depends, and this is important, this is the psychological dependence of what investors expect those assets will produce in the future. Okay? So let's look at this. Global has 3.6 million shares outstanding, and these shares are trading for a price of $14 per share. What is Global's market capitalization? All right, so their market capitalization is simply the multiplication of this number by that number, right, which is 50.4 million. And this is significantly higher than their book value of 22.2 million. So investors are willing to pay 2.27 times the amount Global shares are worth according to their book value. All right, I'm going to run this video and hope you can all hear this.
Market versus book value. If Global has 3.6 million shares outstanding and these shares are trading for a price of $10 per share, what is Global's market capitalization, and how does the market capitalization compare to Global's book value of equity? So to figure out its market capitalization, its market value of equity, we just need to know how many shares it has outstanding. So it has 3.6 million shares outstanding, and we need to know the price of each of those shares, which is $10 per share. So if you have 3.6 million shares and each of them is worth $10, the total value is $36 million. So that's the total market capitalization of Global. Now we saw on the balance sheet that the book value of equity is $22.2 million. Now that's a historical value that's based on the amount of capital paid in and retained earnings that Global has earned over the years, and does not reflect forward-looking things that may also be reflected in the market value of the stock. Remember that the stock market is always looking ahead and valuing the stock based on that. And so if there's opportunities for growth, if the management team is particularly high quality, if they have valuable relationships with suppliers and customers, those will all be reflected in the stock price, but they might not be reflected in the book value of equity. And so that's why in this case, the stock price multiplied by the number of shares outstanding gives you a total market cap of $36 million, while the book value of equity is only $22.2 million.
All right, so I think that filled it in. All right, and then there's a ratio we got to talk about here, and this is a simple ratio. Okay, it's called the market to book ratio. All right, and I believe in example 2.1 that was calculated, because that's also called the price to book ratio. So so here's the equation for market to book ratio. All right, market value of equity over book value of equity. All right, so here's example 2.1, and here they are calculating that. Okay, and that's really a simple division problem. And normally this should exceed 1 if the company's, as they say, successful, right? All right, so I will stop here and I will pick up, because we're almost 15 minutes into this, on part 3, and we'll discuss enterprise value, okay? All right, and I'll make another video.